You ever look at Warren Buffett's legendary portfolio and think to yourself, man, I love these companies, but I really wish they'd pay me a fat check every single month? Well, you're definitely not alone. And that exact thought is the whole idea behind a pretty fascinating new fund that's been making some waves. So let's dive in and break down exactly what this thing is. I mean, this quote just hits the nail on the head, doesn't it? It perfectly captures the problem that a new ETF with the ticker OMA is trying to solve. It's built for the person who totally respects the long-term compounding genius of Berkshire Hathaway, but also needs, or, just wants, some consistent cash flow right now. It's that classic tug of war between growth and income, and OMA is here with a pretty unique proposal. So how exactly does it try to solve that problem? Let's unpack this. We're going to see how this fund, OMAH, tries to bottle up the magic of the Oracle of Omaha himself and kind of re-engineer it for people who are hungry for income. It's part tribute, part financial experiment. Okay, so at its core, you can think of OMA as a sort of greatest hits album of Berkshire Hathaway stocks, but it's been plugged into this machine designed to generate income. It literally buys a portfolio of Buffett's biggest public holdings, and then it uses this option strategy specifically to churn out cash, which it then aims to pay out to you every single month. And when you pop the hood, you'll see these aren't some obscure companies. Nope, you're getting a pretty concentrated portfolio of about 21 household names. We're talking Apple, American Express, Coca-Cola. I mean, this is the Mount Rushmore of Berkshire's public stock portfolio, all known for being these durable, cash-gushing franchises. All right, so that brings us to the million-dollar question. How on earth does a fund like this squeeze such a huge income stream out of stocks that, a lot like Berkshire itself, are famous for paying little to no dividends? Well, it's not magic, it's a very specific and pretty clever financial strategy. And that brings us to the main event, a 15% annualized distribution target. That is the big headline-grabbing number. It's the key marketing promise that makes this fund just jump off the page. It's a massive yield, for sure, designed to grab your attention. But as we're about to see, that little word target is doing some very heavy lifting here. So here's the secret sauce. It's a strategy called covered calls. Just think of it like this. OMA owns the stocks, right? Like Apple. Then, it essentially rents out the potential for big future gains on those stocks to other investors. In exchange for that rent, which is called an option premium, the fund collects cash today. So, what's the trade? You're giving up some of tomorrow's potential home run for a guaranteed single today. And I really cannot stress this enough. That 15% number is a target. It is not a guarantee. It's a goal. It's not a promise. The amount of income the fund can actually generate by selling those options, it moves up and down with the market. So the actual payout you get in your pocket can, and almost certainly will, be different from that big number you see on the label. And there's another layer here. A piece of that monthly distribution, especially with a brand new fund, might be something called return of capital, or ROC for short. This means the fund is literally just handing you back some of the money you originally invested. And while that can be nice for tax purposes, it's really important to get that it's not profit. It's your own money coming back to you, which lowers your cost basis. Okay, a 15% income target from a portfolio of Buffett's favorite stocks. It sounds amazing, right? Almost too good to be true. But as any investor knows, there is no such thing as a free lunch in the financial world. So let's pull back the curtain and look at the trade-offs. Let's just ask it straight up. What are you giving up in exchange for that big monthly payout? Because there's always a give and take. Here are the 4 big ones you really need to wrap your head around. First, your potential for huge gains is capped. Second, the fees are pretty hefty. Third, you're not actually getting Buffett's moves in real time. And fourth, you're putting your eggs in a relatively small basket of stocks. Let's break each one down. Okay, this copycat lag is something you absolutely have to understand. OMAH builds its portfolio based on Berkshire's public filings. But here's the thing. Those filings can be up to 45 days old by the time we see them. So you're not getting a live feed from Buffett's brain. You're getting modeled Buffett based on old data. He could have sold a stock weeks before the fund even knows about it. And then there are the fees. At 0.95% a year, OMAH is not cheap. That's almost 3 times what you'd pay for popular income funds like JPI or JEPQ. And it's a completely different universe from a dirt-cheap index fund. That fee is a constant drag, a hurdle your investment has to clear every single year, year after year. So now we get how it works and what it costs. The next logical question is, okay, how does OMAH really stack up against the other ways you could be investing your money? Well, the most obvious comparison is just buying shares of Berkshire Hathaway itself. With OMAH, what do you gain? You get that monthly cash flow that Berkshire famously does not provide. But what do you give up? You give up the shot at unlimited gains, you have to pay that 0.95% fee every year, and you're missing out on Buffett's actual real-time moves. You're getting the same star players. They're just wearing a different jersey, an income investor's jersey. And look, when you put OMAH side by side with its peers in the high-income world, funds like JEPI and JPQ, you can see they're all using that same covered call playbook. The real differences come down to what's inside, how much it costs, and that really ambitious yield target. OMAH is a concentrated bet on Buffett's picks, while the others are tied to much broader indexes like the S&P 500. So after all that, who is this fund actually for? Is it for you? Let's run through a quick, no-nonsense checklist to help you figure out if it might actually fit with your own personal financial goals. Okay, ask yourself these 4 questions and be honest. Number 1, is monthly income your absolute top priority, even over total growth? Number 2, are you genuinely okay with leaving money on the table if the market goes on a huge run? 3, does that 0.95% fee seem like a fair price for this service? And number 4, do you get that you're buying a copy based on old data, not the real thing? Your answers here will tell you pretty much everything you need to know. And one last practical tip. Because those monthly payouts are this complicated mix of different tax treatments, including that return of capital stuff we talked about, the paperwork can be a real headache. That's why a lot of people find it's just simpler to own these kinds of income funds inside a tax-advantaged account, like an IRA, where all that complexity just gets smoothed out. You know, in the end, it all boils down to this one fundamental trade-off. OMAH is a really innovative tool that's been engineered to do one very specific job: turn a growth-focused portfolio into a monthly paycheck. And the central question it forces every single potential investor to answer is this: is the certainty of getting cash in your pocket today worth sacrificing the possibility of much greater growth tomorrow? That's the billion-dollar question you have to answer for yourself.